What's up guys, Steven Duxter. So today I'm going to talk about the 5 common mistakes you're going to make in your trading career. And in this video, I'm going to talk about as a trader and as a teacher in both perspectives to really help you to lead you to become a consistent trader. So first of all, let's go back into 2016. At that time, I was a trader, just got into the trading career. In the first 6 months, I was tracking statistics. I have already about 30 to 40 samples, and I'm very confident at that time to really trade my own pattern. Now, once I stick to my own pattern and I made about 30,000, 40,000-ish, then I'm that type of person. I always like to go into different sectors to discover new patterns and maybe new method to really trade in this market. So I discovered one of the repeatable pattern that most of the runner doesn't really run over 200 to 300% in one day, but I only have limited amount of data that I can access to. Once I see a runner, if it's reaching about 200%, 300%, I will start to short it. I don't know why, and that's how my stats was telling me. Back into the beginner stage, I don't really have a clear understanding of what market cap and float is. So I don't know how much volume will affect all those little market cap and bigger market caps. Because as I talked about in the previous video, more volumes trading on intraday will affect the winning percentage and the spiking percentage in that one day. Let's say we have a 50 million volume on this intraday. We only have about 2 million flow, maybe 3 million flow. That will massively affect how the stock will be trading and what's the maximum winning percentage, along with the maximum spiking percentage. So in that first few months, I don't really have a system to trade with. Once I had a few wins, about 9 to 7 wins, I got very overconfident. I was shorting anything that was spiking around 200% to 300%. I ran into GBI. Now, I don't really know what low flow can do, what's the maximum potential. So the stock started at 20 cents and spiked it to $2. It spiked already 1,000% at that point. I know there's a rule, never short into midday, and I avoid completely in that midday time zone. I end in the afternoon. So I started shorting at 2, the stock parabolic to 5. And I was keep adding. I was thinking that there's no way the stock can go above 2,000%, 3,000%. This data is already breaking my understanding of general maximum spiking percentage. I was still being stubborn, trying to fight the stock, being angry with the stock. I think this ticker has something to do with me. At that time, I wasn't really thinking in terms of pattern. I was thinking about how to revenge the stock. Then I have about $60,000 account. I was down 50,000-ish, and I was lucky. It stopped at 5 and dropped back to $3. Then eventually dropped back to 2, so I was be able to make all my money back and be able to cut it even. So number 1 rule as a beginner in your trading career: do not be overconfident. As a beginner trader, you will be able to find a useful pattern in about the first 2 months or 3 months, and you will be able to stick it for a while. And once you trade about 7, 9, 10 trades, you will start to get overconfident. That's where the most traders fail. It's because once they get overconfident, then they think they want to discover the maximum potential of you can get from a one trade. They will set it in really big, and once the stock reverses, that one loss can pretty much overwhelm the first wins you have. So that's number one lessons that everybody runs into. So I hope you guys can avoid that. And the first sign you can see is you are sizing in bigger and bigger. Second sign you are seeing you want to really figure out what's the maximum reward you can get per one stock, because it's a human nature, curiosities and greed. I always run into that type of problem, and still I run into nowadays. So it's very difficult to control, but I hope you guys can notice the sign before that happens, so you can avoid that huge mistakes is going to happen every 10 or 20 trade. So that's for overconfidence. Now, overtrading will be the second problem you're going to run into as a beginners. This is the same old term, overtrading. Overtrading is nobody can actually avoid that, because as a human, you are not the perfect robot. You cannot trade the perfect pattern again and again. You're not willing to wait. I run into this type of problem pretty much about 4 to 5 times per year. And now each season, when I run into overtrading, I take about 40 to 50,000 losses for no reason. Now each year I've been getting better and better and trying to count my trades less and less. So what I noticed from the last couple of years, it will be there's only several good opportunities happens within a year. And there's about 20 to 30 perfect trades happens in about 200 some trading days. And that means you can only place one trade every 6 days. So with the pattern day trader rules, I don't really understand that people wants to unlift that type of rules. At the beginning, I was very annoyed with pattern day trader rules. It's because that if you don't have the ability to trade or the freedom to trade, how can you supposed to make money? Now, after a few years, I understand why there's a rule was placed on that 25,000. So let me give you examples about how overtrading is happening without you noticing. And let's talk about Tesla. Tesla was spiking from $300 to $900 in the last couple months. Now everybody started to get excited and hyping it up. When the news was so big, you always do the opposite ways. Let's say Tesla running from $800 to $1,000. Everybody was excited on Twitter. Now look at today, it dropped about 20%. When you are seeing a crowded trade, when you are seeing a stock is spiking from 20 cents to $5, ran about 5,000%. Or 10,000%. That's where you need to stay away. So number one, if the stock is trading a lot of volume, let's say 100 million volume, 200 million volume, the reason why it tracks volume is because everybody's talking about it. You feel like you want to anticipate the stock, especially when the stock's getting crowded on the first screen day. That's where most people lose money. Only 10% people can maybe gain some type of money in the first screen day if the stock's getting really crowded. Now, when the stock is spiking 3,000%, 4,000% without any type of edge, that's where it gets dangerous too, because it will attract more volume. So those type of volumes are people who don't know how to trade and they anticipate in, then end up taking a huge loss after they finish the trade. So that's going to be the second mistakes you're going to make in your trading career. The correct way to really avoid this type of mistakes is to really figure out what's the best trade within a year. Now, from the past year I've been tracking statistics, there's only about 20 to 30 best trades, and there's about 20 other opportunities that consider it's not a perfect trade, but you can still trade it. So overall, total 40 to 50 opportunities you can get per year, and it's considered to be a good opportunity. And I would highly suggest write down the rules and always follow your rule that you write it down. If you break the rule, that's not a rule anymore. I see people breaking the rule all the time and they want to discover the maximum potential on the trade. I would really do that on a paper trade instead of putting it into real time. First, write your rule down. Secondly, see you are following the rules. The thirdly, I want to talk about market cycle. Now, market cycle usually happens when the stock is getting hyped up into several sectors. The Wuhan virus will be the one sector that was hyped up recently. Then shipping sector hyped up back in 2016, followed with Bitcoin. So all those three major hype are causing all those market cycles. So when buyers are coming into this new sector that was recommended by other people, newbies want to trade because they're seeing the potential of the stock varying from maybe $1 to $12. So once they see the potential, they want to anticipate and they end up losing money. Now, including us as a day trader, as people wants to make this as their full career, and people will get filtered out consistently into different seasons. Now, every single year, there will be about 4 hypes within the year. Let's say one low flow just ran rage mode to $1 to $70, and it will bring all those sympathy plays along with him and make all those tickers go 2,000, 3,000%. Now, into all of these hypes will bring new buyers, will bring new short sellers, and people are fighting back and forth in the first screen day, trying to compete and who's going to win. And when you anticipate all those first screen day, especially with no edge, without statistics, you're likely to lose. Once you lose, you get filtered out of this market. So back in 2016 as a beginner, when I see this type of hype, I was getting excited because there's so much action, there's so much opportunities I can really get. When you're seeing this type of hyped up sector, all those patterns will get readjusted a little bit, because when you're trying to adapt the market into different seasons, you have to really notice that what type of time zone is considered to be a hyped up time zone, what type of time zone is considered as a normal market. And you can pretty much notice when the stock is going out of the normal statistics, that let's say the stock went from 1 to 50 or 1 to 70 and it went from overall 7,000%, and that's not normal. When you are seeing sympathy play again bring along with these major spikers, then that's a definite sign that this is a hyped up sector. And you will know there will be a lot of buyers and sellers involved into this type of massive amount of volume. The correct way to really trade it is to not touch these type of sector until they finished hyped up. Because once you know when the sector is hyped up, first of all, you will attract so much volume. Secondly, you will attract so much buyers. Third, you know pretty much all fundamentals are trash. And when you know the fundamentals are trash, that they will eventually drop back where they began, then you can use the buyer previously to short into the resistance. And that's why resistance works pretty much all the time. The respect after the hype will be the money maker after the hype, but 90% of people that jumped into the first hype will lose money. So that's what we call the market cycle. That's why only 10% people makes money in the market and 90% people lose in the market. So all of those three things that I have talked about are pretty much the cause of human nature: greed, overconfidence, and overtrading. And be willing to anticipate because other people are trying to trade as well. Always write down your rules, follow your rules, and be as robust as possible. And I also listed some signs that you can find out before you make the major mistakes. So that's pretty much all for this video. Hopefully this video is helpful. As a beginner, please write down your rules and be disciplined and learn from other traders. The thing I learned from other traders is I always look at their mistakes instead of their winnings. That's where you can improve yourself as a better trader. So that'd be it. Thank you very much, and I'll see you guys in the next video.